Minutes. Good morning, afternoon, or evening, everybody. Keenan here again, and this time we're bringing you a later than usual episode of the Winnipeg Market Watch podcast. And if you're watching, you've probably noticed by now, I am joined, as always, with my co-host Denzel Sullivan, but also return visitor, widely requested, 40-plus year experienced realtor, Guy Boudreau. Guy, thanks again for coming back and talking to Denzel and I today.
My pleasure. Glad to be here.
Awesome stuff. Folks, because we are all such high producers and we are so busy, Denzel's not even in Winnipeg right now. We are going to try to whip through this episode in about 45 minutes. If we run long, I guess I'll eat my words, but we are going to breeze through the market data and this time jump straight into questioning for Guy while we've got him. He's obviously a wealth of knowledge. He has been very involved in every aspect of real estate, both acting as a realtor with the Judy Lindsay team. He has owned RE/MAX franchises and been a broker in the past. And he also invests very heavily in real estate with a significant history and repertoire of rental doors throughout his career, for those of you who don't know. But let's talk about the data that we got for April 2025. Today is May 17th. It's about 12:45 p.m. here in Winnipeg, and the benchmark price actually fell 0.86% from last month, bringing us to 448,400. Year to date, we're still up 8.07%. We are up over 6% from the 2024 high, and we are up 4.5% from the all-time high. Denzel, we've obviously spoken a lot about where this benchmark price is going to land for the year. Give me your quick thoughts on your general opinion of what happened in April and why we had this dip along our path to what we both think is eventually going to be a higher number in the benchmark this year.
Well, I think that for anyone who's been kind of recording and watching things really closely with the market, I feel that we actually had a pretty good December leading up until Christmas. And I think the spring just came super early in terms of just the activity and the amount of listings that were available in the earlier parts of the year. I'm talking January, February, and March. It was low and the activity was high. People were excited to get back into the market because the rates were obviously a lot lower than the last spring market. And I just think that the inventory is finally here. There's a lot. If you look at a lot of MLS areas right now, there's certainly more than 5 to 7 houses per MLS area. And if you're a buyer in the market right now looking, there's options, right? And every time that this happens in at least in Winnipeg, from my experience, is prices tend to dip a little bit. I think last year, looking back at some of the articles that you had produced in the past, Keenan, prices, I think May was still another high month. April it's typically May and June that you see like that peak. Not quite sure exactly why, we're a little bit earlier, but my guess is just because of the inventory coming in a little bit quicker. And then us also having the busier late winter market that we had this year.
Fair enough. And I mean, all of that is completely true. There's no doubt about that. In my opinion, I think there's a lot of other factors that went into this. But the main one to me that I thought probably would have been a factor in this is a lot of the flashing losses that we had in early April in other markets. Generally speaking, I found real estate in Winnipeg rhymes with the rest of the global economy. But when you have financial markets taking 20% dips in a week, that often is reflective of people's down payment money. And I think there is some connection in that, where in early April, especially, it was mostly the first and second week that this was going on. And the majority of this was tariff related, by the way. Alongside the fact that April 16th did not bring another interest rate cut, I think was a cause for some buyers to maybe take the foot off the gas a little. Of course, everything Denzel just said still applies, but I wanted to make sure that that absolutely got stated. Would you agree with that, Denzel?
Yeah, 100%.
Okay. Well, fair enough. So last thing I wanted to bring up here, just because we've talked about it a little bit on this show in the past, but it's something that I'm looking to discuss a little bit more here. the other big Canadian markets are still continuing to suffer. We've got Toronto and Vancouver taking continued losses, particularly in the condo sector, but also the residential detached markets are not having a great year, with some specific metro areas being down even to where they were in 2023 or 2024. That being said, cities like Calgary, Halifax, Montreal, and Edmonton, as well as other smaller cities like the Saskatchewan, Regina, and Saskatoon places there, they seem to be performing about as well as Winnipeg. It's to be determined whether they're going to level off kind of like we are. I'm not sure exactly what's going to happen, but figured it would be worth mentioning that those cities are kind of trading in line with where we are today. As for how we're going to proceed here, both Denzel and I have a lot of questions to ask Guy. And wow, I'm looking washed out. That's one of the issues with the afternoon recording. I'm just looking at this here. I don't have blinds. That's going to be my next purchase. But anyway, is what it is.
Twilight.
Yeah, no kidding. Denzel, did you want to start here by asking Guy a couple questions? I know we've got a list here to get through, and I think he's going to have some really interesting answers. How about you lead this off?
Yeah, absolutely. Okay, so Guy, what are your thoughts on this current high market compared to other seller favored markets you've lived through?
Comparatively, I'm typically in the real estate side, I'm typically on the listing side. So the offers come to me. So in terms of a comparison, when you're sitting with half a dozen offers in front of you, whether it was, 19, 2002 or 2025, whatever, it doesn't matter. You have a bunch of activity and it's hectic. It's what's underlying it that's different, right? When COVID was happening, it was so totally interest rate driven. It was rates just the bottom fell out, and we just went crazy for multiple years through COVID because as an essential service, we were very active, and people with that low rate and working at home and having the ability to buy more money with interest rates as low as they were and working at home and needing more space because everyone's crawling over each other. It just blew up. The high end market, the big houses were selling, and then everything else followed suit. Whereas now, it's supply driven and rates are going down, but it's more of a supply thing. And so it's not affecting as wide a market. I'm finding in that, north of 600, it's stable, and stuff is selling. The odd one significantly over, but stable. But it's in that first, not entry level, but sort of second home, 3 to 5 range, where everyone is there's no product in that space, and everyone's trying to buy, and I've been into like crazy multiple offers. So it's getting the offers is good. It's underlying. Those are the two biggest differences for me, I think.
I gotcha. And actually, I've got a couple questions, but Denzel, why don't you go ahead and take that if you had something you wanted to follow up on?
Yeah, no, I was just gonna more so just elaborate further on the difference in markets between 2020, 2021, and 2022 to like where things are at now. That
Yes.
you say, back then it was very much interest rate driven, and then now it just being more supply driven. I couldn't agree more with that statement. I just think that the rates are I was just getting caught up with kind of where rates are headed and what, bankers and politicians are saying about where that rate is going to end up by the end of the year, and we're expected to have further cuts. And
Mm-hmm.
so like
Yes.
even with low interest rates, there have been instances in Winnipeg history, I guess, of real estate, where prices didn't go crazy. They kind of just like people were like, oh, like it took a little bit of time for the market to realize that it was a good opportunity to get in, and then once that starts becoming mainstream media, that's when it really like blows up. um
What I would say on that is um, a lot of, and again, as it was stated, I've been around a long time, been through many markets, and there's seasonality. There's like the perfect time to do this. And then you have that early spring when everyone's coming out of the woodwork thinking, oh, I'm going to jump in now before the prices go up. And there's no inventory. So when something good comes along, they jump in. And so it's a seasonal thing. And times of year impact significantly. As you get into that sort of early season, spring, and then very limited listings and lots of activity, it drives the market up. But then there's always a balance, and it's usually in late May, early June, when the majority of people that think you have to, like spring is when you put your house on the market. Then there's a lot more inventory comes out, regardless of whether it's a year where there's low inventory or more so. At that time of year, you'll have a flood of inventory, and then that balances things. Then now there's a lot more product. People see that, so then they back off. They don't get freaked out and fight over stuff. They feel like maybe something else better will come along if it's not great. So, and that's a seasonal thing, you know. So,
Gotcha. That's a lot of really good stuff. And my question, it's going to feel like it's been a while since that actually even got brought up, but I generally wanted to know, when pricing listings, now that we're midway through May,
right.
Are you still using the same sort of strategy as it comes to marketing numbers at this point as you were in April or March? Or have you started to change your mind and move things up or down when putting a listing on the market?
Yeah, what you're talking about, Keenan, is an approach to, it's a discussion with an owner. Okay, if the market is very healthy, then I don't talk in terms of value, because the market, when you're talking about an appraisal or an opinion of value, you're looking at historic information. You go and you look at past sales to try and figure out what has happened in the past, and therefore it's a reasonably good guess that you're going to have this as an outcome. And when you're doing that, that's looking at historic information. But when you're in an early market or a very, very hot market, it's impossible to predict where it's going to go. And I've seen offers close to $200,000 over asking, 125 in just normal houses, right? So you can't predict that. So when I'm talking early spring, I'm talking about a marketing number. And that's a number that they, in their mind, based on historic information, are comfortable. If they got that, then they would be comfortable, because it's not fair to go on market at a number that the owner would not consider. So that's kind of my starting point. And that's, then you explain, okay, it's time of year, it's very healthy. That's going to appear to be really an exciting number. As long as you're willing to accept that, if that's all we get, then perfect. Then that's a great starting point. That's a marketing number. But as you move into the summer and there's more inventory, and there's a much higher likelihood that you won't get all of those offers, or maybe you get one or maybe even none, then it's really important to then take into account what happened in that mad rush up in spring, and then start looking at value pricing, so that if it doesn't get an offer, then it's at a number that you can at least negotiate down, if you will, but you're certainly not going to leave anything on the table. So that's kind of how and I'm almost there. I'm not quite there. The last 2 weeks, I've had 3 transactions that I had, say 20 or so showings, and then I'm only getting let's call it 4 to 5% offers on the table, where earlier it was significantly more. And so when you get into that range, you know that you're transitioning. People are starting to think that maybe there's something else is going to come along better. There's that time of year they have time, whatever their psyche is. Then you have to start being careful and not suggesting that it's just going to get knocked out of the park. You got to start adding a bit more money into that to protect the owners, to ensure they don't leave anything on the table.
Gotcha. That is very helpful for those of you that might be selling this spring. Definitely advice to keep in mind. Next question. And this is something that I've been looking forward to asking you for a while, because investors are asking this to me all the time. Okay. So basically, you've been in the real estate industry for 40 years, and I think that your opinion of this is going to be much more valuable than most people's, because this is, I think, year 7 or 8 for me, probably 8. I'll do the math one of these days. But what do you think 2026 will look like compared to today? Do you think that the market in the spring next year is going to be hot like this, or are you expecting some kind of flat line or maybe even decline into our next market session?
Okay. Well, this sort of connects to the thoughts I had just in this last discussion about pricing and timing. Winnipeg has always been a stable market. Winnipeg, and Keen, I think when you first started into real estate and we were, facing COVID and oh my gosh, the world is ending, and maybe I should have, done something else, right? Because holy smokes, the market's going to crash. And my comments were, you just got to just give Winnipeg a month or two, and Winnipeg is historically just a very stable, slow, steady, and you win the race. And I suspect that's what's going to happen into this coming year. It's either, if it's terrible everywhere else and it's impacting us and our psyche, then yeah, maybe it's stable, let's call it. With how our inventory situation is now, with the cost of money in a spring setting, I can't really imagine that we would go below values from previous years unless something significantly tragic happens in the market, like the US comes over the border with tanks or something, right? And then everyone freaks and no one's doing anything. But as far as going down, but as it would, at the worst case, it would flatline, and in all likelihood, seasonally, it will be fine. And I go back on different occasions. I think in terms of 1988, there was like Black Friday, and we were right in the midst of negotiating, almost finalizing the sale of our first Remax franchise. And then Black Friday hit, the market crashed. And in fact, that was a flat line. And I remember doing evaluations in 89 and 90, where you would go back a year or two and still be able to use a house to use as a comparison, which wasn't something I'd experienced up to that point. But then eventually, and that was kind of flatline, and then it started to go again, our normal increases. That was 88, and then obviously 2008, and then COVID. The scare is there. Everyone's worried. There's always a bit of a downtime, and then we just sort of coast through it, and away we go. And I remember in '08, it was like really scary, because like the whole banking system in the US was collapsing, or scary as heck. And we just sort of, I remember everyone was looking at each other. I guess it's time to find a new job, right? But it didn't happen in Winnipeg. Other markets in the country absolutely were significantly impacted, but Winnipeg just kind of skipped through, and then all of a sudden we were back to normal, right? And then things were busy, and then the next spring it was like crazy, and multi offers all the way. It was just nonstop. It's been a very healthy market for the last 14, 15 years in Winnipeg, other than a few months here and there.
Fantastic. Denzel, do you have any questions about any of that before I ask a follow-up here?
Well, I think that I guess if you were to take this period right now, Guy, I guess, call it, when did our correction happen after COVID? Late 2022? If you were to take
Yeah.
now late 2022 to today, could you take those 3 years and say, this was a lot like this?
Hmm. Yeah. I think that when interest rates started to really climb quickly, um, there were two parts to that market. There was the part where people, when it hit and rates were really low, and then like everything I locked in, minimum 5. I was fixed rate. And then there's the other half that were kind of riding with the floating rate. So then when rates started to go really quickly, then that started to impact on the investor side. It started to impact, right? And then people, because it's cash flow driven, right? And then it started to really affect people. I mean, actually, I'm getting a little lost in my thought here. Just could you just repeat that, Denzel? Just
No, I was just wondering, like, if you were to, just because of, all of the experience you have, if you could take the past 3 years from 2022 to
yeah,
25 today, could you say, like, this was kind of like this time when I was in real estate, and because I'm looking at the benchmark price, and if I look at December 2022 to just even today, um, we're like almost $100,000 higher in just 3 years. So if you had bought in December 2022, held that same property, provided there's no problems with it, like, you're making money. Because I look at some of the flips, Keenan and I, we probably had seen this happen twice this year, 3 times, where some projects that I had worked on during that period and sold into the correction, those same set buyers brought that same exact product without doing a single thing except changing the name on the title, and have sold for 50, 60, 70,000 more than what we got. And
right.
I just find that, well, first of all, I find that upsetting a little bit. But at the same time, I just find it so interesting, because it just goes to show that, if you have the ability to hold through these periods of where it's all doom and gloom, like, the real estate tends to always kind of find a way to work itself out, right? And so I'm just curious
Well,
again.
you're into projects and you're into a calendar cycle. And then what happened was interest rates started spiking. You likely had floating rates on some holding stuff. And then, with interest rates spiking, it flattened out the market. But you didn't, your trajectory on these projects is the same. It's not all of a sudden, oh, I guess I'll just hold these products vacant until things change. You have to do something, right? And then so you're selling into a time when there is instability in the market. And that's, I mean, I don't know how many times I have, I've typically I've been a buy and hold, but I have sold stuff, right? And then I look back and I regret it. I always regret it. I think either A, I should have bought two or three of them at the time, or I should have never sold that one then, because now it's done well. And so over time in Winnipeg, with as consistently stable a market as we have, regardless of how insane it is at different times, low or high in the rest of the world, we'll have impacts of 2 or 3 or 4 months. In your world, that's a long time to hold a house and then think, oh my gosh, what's going to happen? So you sell and then you move on. Whereas most people are in it for a much longer period because it's their own thing, it's their home or whatever. And so they're in it for longer. And then all of a sudden, things just get better. So, and then, a year later, when it's a good time, and everything is fine, and you're operating at a good time as well, but then they're operating at a good time, and then they sell that product, and yeah, you're selling into a time when the market is up.
Yeah.
So
Okay.
back to the original question, Guy, is there an era or a 3-year period or so that you would say reminds you of the current state of things, particularly following the 2022 correction? Like, in my head, just as a student of history, I know that we had a pretty big recession in the early 90s. I know we had a recession in the late 80s as well. And I know there was a recession following 1973 or 4, one of the two.
Yeah.
Um,
For
can
me,
you
the
speak to any of those?
1988, and I've referred to that earlier. I was sitting with my business partners, and we were just basically dotting our I's on buying a real estate company, and then Black Friday hit, and we were looking at each other like, "What do we do?" And it did impact on the market in a negative, significantly negative way, because that was a market crash, not necessarily a banking crisis. And so there was everyone's money was worth less, and it impacted over an extended period of years. And that's when I was doing opinions of value and using 2 years back, and it was still relevant. That isn't necessarily what you're talking about, Denzel, in terms of a 3-year period where it's just like constantly going up. Is that kind
Yeah,
Well,
of
just like activity following a correction, I think is more
yeah?
what he was getting at,
The
right? Like,
worst, I think the worst time I've ever experienced was 88 to, and then into the 90s. There was a early 90s. It was a period where the market was really, yeah, it's flatlined in Winnipeg. And, once that ended, then, for the most part, I would say, for the most part, it was healthy. But then once it got to '02, then that's when like multiple offers started, 2002, 2003, in the spring markets. There were then times in the summers and others that it went to normal markets, but that's when we first started experiencing, at least in my career, multiple offers. And that was in the early 2000s. And then I guess, wow. And then from there, I would have to say every spring almost, other than, well, I just can't recall, but I would say from that period all the way through till today, spring markets, typically we would have multiple offers.
well,
okay.
good to know. Next question, Denzel. This one's
Yeah.
for you.
You're gonna ask me a question, Keenan?
Oh, no, wait. I think we already got to that. So it's my turn here. Okay. So, Guy, I know we touched on this a little bit earlier, but if you were to put a property on the market, and let's for all argument's sake pretend that this is a house that must be sold. There's no option to wait it out or try later or anything like that. Like, this is a forced sale. This thing needs to move, and it needs to move quickly.
Right.
But they were to list that project towards the end of summer, or let's say last week of August through to first week of October, which has been a traditionally difficult market to sell products like a flipped home into.
Right.
How would you go about pricing that kind of home, and how would you ensure a high outcome, but also a speedy outcome?
Yeah. Well, it's kind of, those are two different things. Um, if you price the product at a number that because it's a business transaction that you can step away from without loss, and that looks very attractive in the market in terms of it being from a buyer's perspective, really good value. If you have that flexibility, then that's the strategy, right? Because you're ending the market, you can't afford to carry over into the new year, and you want to move it. So if it's a business, you've already had a business cycle leading up to that where you should have had success and profit. So now it's time to make darn sure you don't have to carry. So price it at a number that when you are out of it, and if that's what you get, then you're break even. That number should, because of the way you guys do your business, that number should still be very attractive into the market. And that's what in the fall, I would not counsel that necessarily in the fall to someone that can live in their house over the winter. I would suggest that if it's late in the fall as someone living in the house, then you need to, they want full value for their home. Pricing below like that in a lower market, there's a lot of risk in that. If that's your high point and you don't get offers on when you first hit the market, then you're negotiating into a position of loss. So that's not a strategy I would recommend for an owner. That in the fall, it's usually you have to build now money into the price in order to negotiate. And if it doesn't sell, and you don't have to sell, then you can run through the winter months, Christmas, and now it's March, and the spring is here, and usually the outcomes are substantially better.
Great answer. Any follow up on that, Denzel?
No, I think guys kind of, I mean, we've been through enough spring markets together, or sorry, late spring, early summer markets, Keenan, to kind of know what to expect. I mean, obviously every year is different. There's different factors affecting the market, and I think that yeah, I don't really have too much to add on, but for myself, I guess going into this later spring market now, pricing strategy is going to be a more longer conversation, absolutely. And
Mhm.
we're going to have to look really close at like, okay, what are we really competing with, not only in this neighborhood, but also citywide, right?
Yeah.
Yes.
And I
What
think that the market, by the time you get into late spring, there's also already been a pretty significant jump. So now you're dealing with historic information that's relevant to the month, as opposed to in the early spring, you're looking at late fall data, which is usually a bit of a more down market. So it's harder to predict that upswing, right? Now you're already factoring in those significant gains. So then, the pricing is more, okay, I want to price it to go, but I want to don't necessarily want to give it away. By the same token, to price it below what you would hope, when there's a lot more competition, chances are you could get hurt. So you still have lots of traction left in the market. There's lots of runway left. Price it a little higher, and it's just going to take a little longer. But eventually you'll get there. There's just not enough product right now to have something decent sit for any length of time.
I just want to add one more thing before we move on to the next question here, Keenan, and it's just
Go
that
for it.
I actually find that this is where most investors, or at least flipping houses, make mistakes because they get super ambitious as to what they can get because of where the values are in January, February, March. And they're like asking their agent, hey, what's the comps for this? They're looking at the comparables and it's like, wow, Bungalow in Westwood, this thing got 525 and it wasn't even fixed up. But if you go back in time and kind of look at, well, what was available, well, there was two houses for sale at that time, right? And you might maybe had like 10 buyers.
There was
Uh,
an analogy, Denzel, and it was just because it was a woman talking to her son that, and she's trying to give him some rationale about what to do. And just because Johnny jumps off the Empire State Building doesn't mean you have to, right? And so that's what happens in these multi-offer scenarios. They're very subjective, these offers. It's hard to tell when that one winning offer is 550 grand for a little wee thing in a and your eyes are popping out. Well, man, that's mine's worth that all day long. But that was one person probably a dozen, and But you don't know the subjectivity of it. You don't know that that one person's mother lived across the lane, and they've been searching already for 2 months and losing, and this was the perfect house, and they don't care. It no longer becomes an investment thing. It's a subjective, have to have it kind of emotional thing. And you can't necessarily guarantee just because that person jumped off the Empire State Building at that number that you put the next one up and just they're going to do it. It's just not the
Right.
case.
Well, we all know from trading in real estate as either agents, investors, or whatever. I'm sure we all have that story of the multiple offer situation where we know what the second place was and we
Yeah.
know there's a gap. And
Big time.
and
Yeah.
that doesn't show in the data. That and it can absolutely happen, right? Like it's just one of those things that it's not readily apparent, but the data will skew the market. The truth of what happened isn't necessarily immediately clear. And I've always I've heard people use that as an argument against the blind bidding process, but that is probably too big of a topic to get into here on a short podcast like this. That might be another article or another episode altogether. But
I
um,
just want to give an example.
go
Keenan and
ahead.
I actually wrote on a
Just
property
be,
in
just
West.
please be careful. Please be careful.
Oh,
You
well,
can say it, but please be
I'm
careful.
not going to say an
Yeah.
address or anything like that, but
Okay.
we wrote an offer, two offers on the thing, and Keenan calls me. He's like, "Yeah, man, I don't think we're gonna get it." I said, "Okay, fair enough." And then we go and look at what it sells for, and we're like miles apart as to what it got. Now it's like that just goes to show again, like we don't necessarily know like what that second offer was, or third or fourth, and all it takes is just one person to go do whatever, and all of a sudden now that's what everyone else will see.
There's investor in your space you're usually competing against guys that deal write offers with a calculator in their hand, right? That's how you deal with your offers. What's it going to cost me? What do I think it's worth into the future? And so that's one way of looking at it. And if you're in a space and you're dealing on a property that like the owners can't go to market, it's derelict, it's, you know, they have a hoarding problem, all kinds of reasons why people are embarrassed to put their house on. So they deal in your space. You guys go in, you walk your calculator, and your offers are fairly competitive. But when you get into a beautiful home or a nice home, those that subjectivity, that personal approach to what they think it's worth to them is dramatically different. And they're not using a calculator, they're using their heart, right? As far as how to figure out what to offer. And but then the others, and this is something that's interesting, I've often found with the space you guys are in, is when you finally get your product ready, it's having that homey touch feel to it. If you don't have that homey touch feel to it that will resonate when someone's looking at a property emotionally, you don't have that same intensity of need that you know you'll get from someone that's, you know, the flowers are perfect, and you know, a home that someone's in loving. You guys do a good job repairing everything, looks good, but there's usually things that cost money that are just kind of, oh, they can do that, it won't, you know, that's something they can do, and it does impact the market. It's a balance. How do you know, like, how far can you get into something before it's too much, right?
Exactly. And that's those darling houses or the sweetheart homes where somebody's put that extra homeowner touch into is something that I, as an agent, have started to really consider when it comes to assessing comparables.
And then when you're using that information about opinions on what you think you can get for your property, even if it's the same size, similar street, all those things, if it doesn't have that warm, fuzzy feel to it, it can impact value.
Yeah, 100%.
Makes sense. Makes sense. That was a really nice tangent we went on there. I actually like the discussion of that conversation, and honestly, I do think that that's something we could probably build an entire episode around when it comes to flipping houses and getting that homeowner touch and how to do it, or even if you should try. Because I know Denzel and I have had extended discussions about why are we going for top 1% ARVs? Like, is it necessary? And
I
maybe you can speak to it, but or either of you can. But what are you aiming for mostly, Denzel, these days? When you see an ARV, do you want a 1%er, or are you happy with an 80 or a 90?
Well, it's always good to know kind of where the 1% is, so you have an idea of like how crazy things could get. But price adjusting, 5 points from that is never a bad idea because we really don't actually know what you're going to end up with at the end, right? Because one, all it takes is, your actual buying agents, when they're looking at your property, for them not to agree with your pricing and then for them not to advise their clients to write or whatever the case may be. So, yeah, it's just a good way of kind of building that into your numbers when you're going into it. Be like, this is the absolute best case scenario because of XYZ. And let's not be super disappointed though that the most likely scenario is probably this. And it's good too, like just as an example, I buy a property for 210,000, it's worth 350 all day, right? And it needs a lot of work. Let's call it 70 grand, right? So you're into that property for 280. If you listed it for 299, I'd be kind of scared, right? Because it could maybe just get 300 or 310 or 315. So it's just like when you run your numbers or you find a deal, run your numbers as if you were gonna just get asked. And if you get asked, don't be disappointed that you didn't actually, get what you were supposed to get, because that's just where the market was by the time you finished, right?
and
Uh,
that's a overall philosophy, but there's also timing. Time of year can impact, and so you
oh,
can, if you had a magic wand and could buy all your inventory and then have everything ready on the 25th of March.
Oh,
Yeah, exactly.
I have
Hey,
like
it's
15
only-
houses to sell.
Yeah. Then
yeah.
everything is, the world is a wonderful place, right?
Yeah.
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 Guy, I got another question. We'll just move
Yeah.
on. Well, as a landlord, if you had mortgage renewals coming up on your properties in the current rate environment, what kind of mortgage would you be looking to secure right now?
Hmm. Yeah, well, I have a bunch right now that late 24 and into 25. I have a bunch that are now floating. Um, I've had a lot more time in these properties, and so even though they're floating, they're not heavily weighted with mortgage. There's mortgage, but there's lots of equity, and so I've been just floating for now. And because I expect in June there's going to be another bit of a drop, a quarter point. That's basically on. I mean, I don't know, but I'm reading that that's the case, and I can sort of wait it out. And if it doesn't happen, then I'm suspecting by July 1, I've got a decision to make. And if I do it, if I'm comfortable with the portfolio the way it is, then I'm probably going to go probably 3 years is what I would lock. And
You'd
then,
lock through this.
yeah, yeah.
Yeah.
And then it's going to bring my overhead down on the mortgage component, but then I have predictability. And some of that has to do with where I'm at in terms of my, my working life and, but um, that's what my strategy is right now.
Makes sense. I like that answer. And as somebody that will have an early 2026 renewal, I've started to ask myself the question of if it were today, what would I do? I'm not planning on renewing early, by the way. And for those of you out there, I'm not a mortgage specialist, but if you're going to try to renew early at a time like this, I'd say you're nuts, unless you've got a really, really good reason. I don't see why you'd break whatever you've got, especially if it's from 5 years ago.
I
But go
go.
ahead, Denzel.
Oh no, I was just gonna say that I actually had my renewal just this month, and me and Suchai, yeah, we actually just we did a 3 year. But it was interesting. The bank was offering 3 years, and if the rates happen to fall lower than the current fixed rate we have, we can lock in on for like on a longer term, 4 to 5
Oh,
years. If it goes
okay.
to, let's say, 3.5 by the end of the year on
That's
five
pretty
years.
good.
Yeah, it is pretty good. So yeah, 3 years I think is a good timeline. I'm also a little traumatized from like COVID and
Yeah, no doubt.
not taking advantage of the low rates and not knowing enough. And so now I look at it and I'm like, well, I just don't even want to deal with it. I'd rather just have some certainty in my life, knowing that like, hey, this is what I'm going to be paying for the next X amount of time, and it's budgeted in and it's not a problem.
I
I
would say that the last 10 years coming to this point, all of the long-term stuff that I had, I locked in for 5 years because at the time I did it, it was it was okay based on rent, based on overhead, based on everything, a 5 year rate. You could have got a little bit shorter, but and a little bit lower, but at the longest term, it was still a really good investment, or at least the component of expense was totally tolerable. And I locked for 5. So all of my long-term stuff, I locked for 5. And then I think right near the end of that, I think I cashed in when the rates were around 2 or 1.9, 1.8. I got out because I didn't want to wait that extra time. I got out of everything and then I locked in low at that 1.9 and 1 point and then 2.1, whatever. And everything went long again. I did everything for 5 years. Yeah.
and I remember that day. It
What's
was
that?
I remember the day you did it. It was
Yeah.
June 2020 in the pandemic. It was one of those sweltering hot days. And I'm going to embarrass Guy a little. He was shirtless on the couch on the phone with multiple bankers, mortgage docs scattered all over the table, and a bowl of chips nearby. and Guy was crunching away and telling the banker to lock everything. I distinctly remember walking in the room and I said, "What are you doing?" And you're like, just locking in some mortgages here. Rates are really good, by the way."
Yeah.
And then off I went to the basement. But
That's funny.
I do remember the day that you did that, and it was a wise thing at the time. I wish we had the podcast back then to talk about this, because
Sure.
a lot of realtors in 2020 were telling people, ride the variables. Like, why wouldn't you? It's 1.3, 1.4 if you're CMHC. It's like 1.6 if you're not. Like, how could you not be on a variable right now? Well, we know what
the variable talk from practitioner's perspective means at that rate versus the 1.9, they can afford a more expensive house, and that doesn't, and then commission on $100,000 more expensive house is a benefit, right? So, that's
complicates the matter.
complicates it. I've always, and I think I've instilled that in you, Keenan, is take the money out of it, and in terms of advice to people, and to make sure that that you can give your gut. This is what I'm thinking. The money should be out of it. It should be what's in best interest for the client, for sure. Yeah,
absolutely. And that is something, even from the very first real estate transaction that I conducted when you were with me and I was asking you for help, you right away said, "Okay, no money here. Just say what needs to be said." And I have done that. I've made that a paramount tenet of my real estate career. So thank you. I think that was a very helpful piece of advice. And I think that anybody in any trade in real estate, whether you're acting as an agent or even a wholesaler, just say what you need to say and make sure you tell the truth.
Yeah.
So another pivot in this conversation here, I want to talk a little bit about weak points in the market. Guy, I'm curious, from your perspective, with all of your experience, do you see anything that concerns you in the Winnipeg real estate market right now? We have cities like Toronto and Vancouver where condominiums are absolutely in the toilet with no possible sense of recovery. We've got lots of areas and lots of price points in Winnipeg that are behaving very differently and sometimes dramatically differently. As you look at the current situation, do you want to share a little bit of your thoughts on where you think the weakest points are for us?
Yeah. I think you're probably more on top of the investor side. From a weak point perspective, I would say it's more of a seasonal thing for me, and it's a price range thing. There's so little inventory in the second home buyer space that it's super healthy, and it will continue to be so. In the higher price ranges, with people now having to go back and not working from home, that was kind of driving that higher end market, and rates are, they're coming down, but they're still relatively high. That, I think, is, you have to be careful in pricing, and be a lot more careful in your analysis to make sure that you're not giving over exuberant advice on the more expensive stuff, knowing you just received a really significant outcome on a $400,000 list that went to, 475 or whatever. So, but
Sensible.
other than just more the seasonal and just the state of our particular market this year, that would be it. It's just there's segments that are better than others, and just to be a bit more careful on pricing, and make sure when you have conversations about market price or value price, that people understand that if whatever that price is, if that's all you get, are you okay with that? And if they are, then fine, then move forward. But if they're not, then you have to go higher, and then whatever the market's going to do, what's going to do.
Makes sense. We're almost out of time here, and I think Denzel's laptop's almost dead. So, Denzel, you know what? I actually think you should ask Guy this last question, because I know that this is something that you and I have talked about a lot. And why don't you ask Guy the last one, and then we'll call it an episode.
Okay. So, Guy, if you were in your 30s again today, would you be looking to buy and hold, or would you focus more on flipping, listing, and short-term strategies?
Right. Um,
Back to the 30-year-old guy.
as a 30-year-old guy, I've done both. And in my 30s, I was already into multiple properties and stuff like that. What if I could go back and tell myself to do something, it would always be to find a way to keep it. That would be what I would say. Find a way. Because I have sold stuff and it was for different reasons. Business partner, you know, just personal situations with cash and money and needing money to do something else and find a different way to do it. Keep real estate. Um, yeah, if I had to tell myself anything looking back, if I could conduct myself, I would buy and hold, and I would lock in as long as the rate I'm locking at is sustainable. I would go as long as I possibly could, and knowing full well that in Winnipeg, it's a stable market. Houses are homes, not commodities. And there's always a reasonably stable rental market. So rents are stable. They don't typically go down. They're not driven by condo stuff where there's gluts and you're fighting for tenants in places like Vancouver and Toronto. So rents will drop and stuff like that. It's as long as you can sustain the investment, find a way to keep it. That's what I would say.
Yeah.
So you guys, even though it puts us out of business, uh, buy and hold, and you'll create wealth. And try not to uh, tap these investments for money unless it's to buy more real estate.
Yeah. I
Well, there
definitely,
you go.
I look at some of the stuff that I'm selling right now. Um, yeah, 5 years is, what I feel like is the magic number. If you own a property for 5 years, you're most definitely likely going to see, unless something crazy happened, like tenant just completely destroyed the property, but there's usually enough principal pay down. The market did whatever it did. I think historically Winnipeg real estate's something like 2 points a year or something like that. 10% increase in price, and then, what is it, guys? About 5% every year in principal pay down. Is that right?
Depends on your amortization and
Depends,
how
right?
much it is.
So
Yeah.
let's call it 25% you're able to pay off, or 20. That's like a 30% spread between what you bought it for and what you're going to be looking at 5 years down the line.
That's always a very fun thing. And I usually do that at the end of each year because I have to, report income expense and mortgage amounts. And you talk about interest paid, but then when you're calculating the interest paid, it is a deductible expense. You also have the column that says a person was living in your house and each month they were paying you an amount of money. Let's call it $500 a month, which is $6,000 a year, that they were paying off your mortgage amount so that at the end of that year, you have $6,000 more of equity. You start adding that up. And that's a kind of a nebulous thing. Like you don't really see it because it's a paper gain, but it's always fun. And then you calculate all that up, and holy man, like for years I've been making way more money in those adding up those increments than I've
Yeah.
ever been able to generate, running around like a mad person, right? Selling. So
I think for me, sorry, Keenan. Um,
No, go ahead. I want to hear what you have to say more.
yeah, I was just gonna say, I think for me, at this very moment in my life, I'm not even in my 30s yet. I'm very close to it, but I just feel like having a lot of cash is what I'm more interested in. Now, however I get there or whatever, um, is how I get there. But I just find the the whole idea of real estate for me when I first started out was I wanted to have options for the way I choose to live my life. So, I have a good month, a good year, whatever the case may be. If I want to go and take the family out to, I don't know, and it doesn't nothing extravagant, but like just like at a drop of a hat, take them to Hawaii or wherever in the world, or I feel like buying a Porsche today, I can go buy that. Like just stuff like that. I know it sounds crazy and it's totally materialistic, but like that's why I got into real estate to begin with. I just wanted options and to live a big life. And so that's kind of why today at least my idea of like what could I do? Like if I had to choose, Kate, can I make 60 grand in 3 months? Or do I make this 105? I'll just take the 60 every day. Me
And
personally.
there you go. Right.
I would
Some
try
people-
to find some balance because I know, and trust me on this one, as long as, especially, see, I've been in real estate my whole like business career. And so I've been there. I've felt that. I wanted to take the kids to Disney at the drop of a hat. I wanted to drive a Jaguar. I wanted to do this. Yeah. You know, all these things are there, and it's you're young and you want to express your success and you want to feel your success and you want to give to the ones you love. I would just say find balance though. Just, you know, it's a book I read years and years ago. It's called The Wealthy Barber, and it talked about saving 10%. But if you could save 25% of your investment properties for the future, and then sell, flip, whatever you want to do, refi the other 75 to live the life, that would be a real solid winning strategy when you start to come to your senses at 45 and 50 and realize that you wish you shoulda, coulda. You've already got that. And
Yes.
got an amazing place to start from to get to your, you know, 50, 60, whatever, right? So.
Mhm. Well, there you go. That's some wise words from someone who's already walked the path. And Guy, obviously at your age, like you're in a very different situation than most of our listeners. But a lot of our listeners probably would be thrilled to be in the position that you're in their late 60s, where they've got multiple properties with good tenants making money. Yeah.
Late 50s.
Late 50s. Okay. Yeah, there we go. Yeah. This is a dude that was trading in real estate through the 1980s, but he's only 50, you guys. He's not really sure how that happened, but
I have a business partner that bought his first house at 15.
Yeah, that's not even legal now. Like literally, it's not even legal. But
well, that's what mom and dads are for, right? Yeah.
No kidding. Anyway, that Guy, I'm really thankful you took the time to sit with Denzel and us and hear some of these questions. We tried to tailor the conversation based on questions that a lot of investors ask both of us, and we figured with your depth of knowledge and all of your 40 years of experience in the industry that these people who put these questions forward to ask you are hopefully going to be really happy with the answers. I know I am. Denzel, any closing thoughts beyond that?
No, I think no, I don't really have much to say, but maybe just that for anyone else who is, you know, again looking for their first deal or in the market right now to buy. I know that oftentimes in this podcast we talk about do's and don'ts. Um, I remember vividly 3 years ago that this is a time of year where a lot of people made mistakes because of past data. Just be careful out there. That's all.
Good message.
Yeah.
Okay. Well, gentlemen, it's always fun to talk. And Guy, we'll have you on one of these days soon and get your perspective again when we need it the most.
Very good. It's always a pleasure. You guys take care.
Have a good one, everybody.